Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So today we're going to be talking about an investor that I've actually just recently come across who has a strategy that is very similar to my own, and he's an investor that has had phenomenal returns over the last 20 years, really. And he's one that I'm actually going to be adding to my regular sort of 13F check-ins. So the public filings that come out every quarter that allow us to see what big investors are buying and selling to allow us to, generate our ideas for our own investing. I'm going to be adding them to that list. So pretty cool. I don't add new people to that list very often at all. So anytime that does happen, I think it's definitely worth letting some other people know as well. So I hope you get some value from that. But before we get into the video and sort of discussing who this person is and why I'm starting to follow them, I've just got to give a quick shout out to Jason Rothman over at the After Dinner Investor podcast. That's a podcast I've been listening to for a few months now. If you're into Warren Buffett and Monish Pabrai, Guy Spier kind of style value investing, definitely one worth checking out. And that's the podcast where I actually first came across this new investor in the first place. So shout out to Jason. Go check that one out if you're interested and if you haven't already. But for now, let's get into the video and let's dive into the new investor that I am following. Okay, so before we dive into the details on this specific person, I just want to give you a quick sort of overview of my criteria for when I'm trying to add someone to this sort of 13F check-in list and the list of sort of gurus that I'm following. Because there's a few of them and there's a couple of main reasons why I do it. So there was a study that came out a number of years ago, which I'll put up the name of it on the screen here and link it down in the description. It basically came out and said that if you'd copied the investments of Warren Buffett, if you just straight cloned those investments over the last sort of 20 or 30 years from the 13F filings, and if you waited until the following quarter and you paid the highest price possible that quarter, you would have beaten the market by north of 10% a year. Making north of 10% a year for a long period of time is quite impressive. Beating the market by 10% or more per year in a period of time where it went up a lot is extremely impressive and will make you very rich very fast. So that's one of the reasons why I tend to follow the 13Fs as well. There's issues now with Warren Buffett specifically with his 13F. So he's now in a situation where he's at the tail end in terms of, or at the top end in terms of scale. So at the moment, he's really restricted to quite a small number of companies just because he's managing so much money. So if we're looking for investors that have access to everything and the ones that are going to perform very well going forward, we have to almost look at trying to identify the status that Warren Buffett was at sort of 20 years ago. So we're looking for people that have access to, ideally it's still a large range of companies, have very good performance track records, and have a strategy that's aligned with my own. So there's a lot of people out there with good performance track records, and some of it is just pure luck and it's from speculation. They've had a couple of stocks that have been 100 baggers or something insane, and they've taken a lot of risk to get there. That's not the type of investor I want to follow. I want to find someone with a sort of value strategy, someone who's looking at the intrinsic value of a business, buying it for substantially less than that. And I want them to be someone that runs, a reasonably concentrated portfolio, has, doesn't use leverage, ideally doesn't short significantly or anything like that. Someone with a strategy very aligned to my own and something that I can, clone if possible. So that's my quick criteria. Let's get into David Abrams, who is the name of this new investor that I'm following. I'm going to read through an article from actually 2014. There are more recent articles on this guy as well. But this one I found from 2014 gives a really good overview of how his track record with investments has been, and his strategy and where he came from and all that sort of thing. So let's get into that. I hope this is of some value and you can add him to your list as well. Basically what we're trying to do is identify the next Warren Buffett and, someone that we can follow the performance of for the next 20 years. Warren Buffett is unfortunately probably not going to be around in 20 years. and he's working with such scale that his universe has shrunk. So we're looking for people that have still that large universe, smacking it out of the park in terms of investment for performance, and I think we've found one here. So let's get into the details. Okay, so I'm going to read through this article, and again, I'll put it down in the description so that you can read through it yourself if you'd like. The name of the article, it's from the Wall Street Journal, and it's called Hedge Fund World's One-Man Wealth Machine. It's my kind of title. So I'm going to read through some points in this very quickly, and you should get a good feel for why I'm adding this guy to my list. So in a Back Bay neighborhood of Boston, one man is building a moneymaker machine that rivals some of the hedge fund industry's biggest names. Calls to his office go unreturned, even from those eager to fork over eight-figure sums. Potential investors say. One industry veteran referred to him as a unicorn, as few people have literally ever seen him. The hedge fund manager, David Abrams, has personally become a billionaire, as well as earning billions more for his wealthy investors. Over the past 5 years, running what is effectively a one-man shop, according to the company and investor documents reviewed by the Wall Street Journal and people that have worked with him, his firm, Abrams Capital Management, manages nearly $8 billion, and this is in 2014, manages nearly $8 billion across 3 funds, and is discussing raising money for a 4th fund that could help them push its assets past $10 billion. In an era of star investors who appear regularly on television and talk up their ideas, Mr. Abrams, 53 years old, has never spoken at an event open to the public. He'd probably prefer that you would not have found him, said Roger Brown, president of Berklee College of Music, where Mr. Abrams is a trustee. Abrams Capital Management's main funds has posted an average annualized return of 15% since its founding in 1999. And just to take a quick break here, a 15% return over a long period of time is ridiculously good. To do that since 1999 to 2014 is insane. So if you remember back to 1999, S&P 500, NASDAQ even more so, was insanely high. That's kind of mid-tech bubble type stats. So if you're going from 99 to 2013, I did the maths, and over that period of time, since you started at such a high point, there was only about a 5.5% sort of percent return over that sort of 13, 14 year period of time from 99 to 2013. And meanwhile, David Abrams has done 15%. So he's been beating the market by about 10% per year through that period of time, which is just ridiculous. So just thought I'd let you know that. So carrying on here, the firm invests in a relatively small number of beaten down companies at a time, mostly through stocks at present, though it has dipped into some of the more talked about fixed income deals of recent years, including the unwinding of bankrupt Enron Corp. Among its recent stock holdings have been, we don't need to go through the stocks that he held in 2014, that's all right. Mr. Abrams is also among a small group of investors that has taken a big bet on government-controlled mortgage companies like Fannie Mae and Freddie Mac, wagering that the Obama administration's plan to wind down and replace the entities will fail, according to investor documents. And this is where it starts to get even more impressive again. The firm employs only 3 analysts and a small back office staff. Even that said, Mr. Abrams approves all trades personally, according to people that have worked with him. Other firms of comparable assets can have hundreds of employees. He also built his fortune with the equivalent of one hand tied behind his back. His firm uses no leverage, no borrowed money, and it often sits with billions in cash. It currently holds about 40% of its $8 billion under management in cash, investor updates have shown, and that again is back in 2014. Mr. Abrams got his start in 1988 at Bellpost Group, also based in Boston. If you don't know Bellpost Group, that is the fund run by Seth Klarman, a very, very famous value investor. And I'll put up a screenshot of his book here. I wrote a book called Margin of Safety, and it's there was such a limited number of copies that it's now the most expensive investing book I think you can probably buy. Last time I checked, it was north of $1,000 to buy a copy of Margin of Safety. So that's Seth Klarman, and that's where David Abrams got his start. So The two remain friends. Mr. Klarman's personal foundation has put money into Abrams' capital funds. Mr. Klarman described him as a protege and smart as a whip. So he loves a good puzzle and a good treasure hunt. People who have worked with him said the University of Pennsylvania graduate who majored in history is introverted and cerebral, the son of a stockbroker and psychologist and father of two. He's an avid follower of jazz music and a fan of the band Earth, Wind and Fire. So lots of other stuff there about just his personal background, to be honest. Last year, he collected more than $400 million on the back of a 23% return from one of his main funds. Yeah, pretty crazy. So that is a very quick overview of David Abrams, and there's a lot of things from my perspective to like in that article. So just to go through some of those things one by one in terms of why I will be starting to follow this guy. He's basically a one-man band. So I'm not a huge fan of people that have massive investment teams. Monish Pabrai often tells us that an investment team is an oxymoron. You know, if he was to employ an analyst and an analyst brings an idea to Monish Pabrai, he then has to vet it himself and identify things that he may have missed, and they might not have the exact same circle of competence and all these sorts of things. So the fact that he runs as sort of a one-man band kind of shop is very impressive. The returns are obviously phenomenal, so that's always a bit of attraction for me. But the way he achieved those returns is even more impressive. It's a similar approach to what I'm trying to take. So he's buying a little bit in the bond market, but predominantly in stocks, and he is buying beaten down companies. He's looking for, when the market has been pessimistic and being able to load up the truck, and then selling into optimism and high prices and so on. A couple of other things I really liked. He uses no leverage. Big fan of that in the stock market especially. So yeah, he's not trying to juice his returns up with leverage and not exposing himself to massive downside if the market does come down. And he's willing to sit in a lot of cash and be very patient. So he can have up to 40% of his fund sitting in cash at any one time if he thinks things are expensive and he's struggling to find deals and so on. So a lot of things to like there. I'm going to be adding David Abrams to my list of investors to follow. Hopefully you guys are too after seeing that article. Again, I'll link it down below. If you've got any other gurus or anything that you'd like me to have a look at, let me know. And just finally, having a quick look at David Abrams, or Abrams Capital Management, as you have to search. Just having a quick look at his current 13F and his current biggest holdings. If we look at his current holdings, I'll put up a screenshot here of his current 13F and his sort of top 5 holdings at the moment. As it stands right now, he has anywhere from, say, 6.5% to about 19% of the portfolio in those top 5 positions. So pretty cool to see some big, heavy position sizing up the top there. All of those companies are pretty much things I've never heard of. I've heard of PCG, and that's basically it. So there's some work for me to do, which is always nice to have some companies on my radar to keep digging into and that sort of thing. So that's the 13F. Again, I hope you enjoyed the video. If you did, hit like, hit subscribe, and I will see you in the next one. Cheers.